What's up, everybody? Is there possibly another massive stock crash coming like we had in 2008-09 when the market dropped 54%? There's a lot of people talking right now about this Evergrand company out of China, one of the largest real estate developers in the world, over $300 billion in debt. And these guys supposedly just missed their first interest payment of about 84, I believe, $3 million. $83.5 million. This was in Wall Street Journal. It's been being talked about. I don't know if you paid attention or not. But anyway, these guys supposedly just missed an interest payment. What's that going to mean? How's that going to reverberate around the world with everything? So our guys are going to talk about this. There's some other things that have come out too. Our chief market strategist and chief equity strategist, Jeff Bookbinder and Ryan Dietrich, and they're going to come on here on the podcast in a second. I'm going to bring up an episode about a little clip of them talking about this to tell you what they believe. It's pretty much what I believe as well, but I want you to hear it from them as well. But a couple other important things they pointed out here, and let me pull up this chart. This is a very interesting chart. There have been no 5% pullbacks. If you take a look at this thing, no 5% pullbacks all the way since October of 2020. And that is pretty rare. Let me show you this. Let me scroll this up. So what you see here on the left are the number of times that there's been pullbacks during the year of 5% or more. The average is this line right here, 3%. And you can see there's been many times we have 4, like back in the 70s, had 6 to 7, 8. I mean, you can see this all the way back to even 2000, or right here's the big one, 08, 09 area, right? So massive pullbacks. We have not had one, not one since 2020 of October. So let me get my twin brother off of this. You don't need to see him on there. But it's pretty rare because the last time that's happened was 1990, 1993, 1995, and 2017. The average, like I said, is about 3 times. And with stocks up about 20% year to date, you know, there could be some volatility coming up over the next few weeks. And the other thing they point out is September. So this chart you're seeing here, that last half from like the 19th through the end of the month in September is usually historically one of the worst, which kind of ironically, we've seen some volatility here recently. So whether that plays out or not, what's going to happen in the fourth quarter coming up? So we'll talk about that. But let's get in Ryan Dietrich and our chief market strategist, equity strategist, Jeff Bookbinder, so you can see this and what I'm talking about. They're going to talk about this right now on their recent podcast. Here we go.
Kind of walk me off the ledge why this isn't the first domino. This isn't another Lehman moment like we saw, by the way, exactly 3 years ago right now.
Yeah, I think there's really 2 big reasons. If you try to keep this complex situation simple, why this isn't the next Lehman, or maybe you go to 3 reasons. You know, one, I mean, the Chinese Communist Party is not going to let this become contagion. Because, you know, if Chinese banks go down, by the way, Chinese state-owned enterprises, right? They're owned and controlled by the Communist Party, essentially. So you have, you know, the Chinese government needs the banks to function and the financial system to function to provide credit to be an engine for the
Jeff,
Chinese.
Hold on one second. I'm sorry. You know, most people maybe still don't know what this is. I'll just set this up real easily. Again, this is one of the largest real estate companies in the world with more than $300 billion worth of debt. It's leveraged. All of a sudden, this company they can't repay their all the debt they have, and they're starting to go under. Real estate stocks in China are just crashing. Chinese stock market's been crashing. So I don't know if we really sum that up for the average listener, because again, I just heard of this company 8 days ago, so maybe this is the first someone's heard of this company. But the worry again, guys, is that the real estate market in China is hot. Now it's starting to crater. Large companies are cratering. What could that fallout mean? Sorry, Jeff. I just wanted to make sure we kind of laid the groundwork there. So yeah, pick it up where you were there. Sorry about that.
Yeah, sure. No, glad you did that to make sure everybody knows where we're at. Yeah. So, you know, the question is, you know, just like Lehman failed and that created market contagion, will Evergrand be the same situation? So, you know, reason number one is Chinese Communist Party control. They have tremendous control over their economy. They don't want this to become contagion, and so they won't let it become contagion. That's reason number one. Number two, there's much better collateral, right? This is a property development company. They have property that can be sold, even if it's unfinished property. They have other things that can be sold too. Lehman really just had a bunch of securities, and they could not be sold for the most part. So in a bankruptcy, the collateral against the debt is going to have a lot more value, right? You wrote about this on our blog on Friday, Ryan, on lplresearch.com, right? So the bankruptcy process will, if it happens, which is probably more likely than not at this point, will result in higher recovery rates. And then the last thing is the banks in China don't have as much exposure to this, right? And, really broader. They don't have as much exposure to Evergrand as the global financial system had exposure to Lehman-backed assets, right? It's just not as broad. So this is going to be contained to China because there's very little exposure to Evergrand debt held outside of outside of China and outside of the Chinese banking system.
Absolutely.
There you go, guys. So that's our take on the Evergrand. And one thing they mentioned going on there just a little bit more is that Evergrand's debt, they're already known to be really kind of high yield, high risk debt. So the investors that are already in that company, investment wise, properties, whatever, they kind of understood that risk going in. So there talks about how it's not as widely spread amongst all kind of banks across the United States. That's well known. Lehman Brothers, on the other hand, they were considered high quality, I think like AAA rated paper, which means the best of the best. And a lot of different banks and a lot of different institutions had that. And when that all went down, it was just a huge ripple effect with all the mortgages and everything like that. So that's why our guys, and I pretty much am on camp with that, on point, is that I do believe that's the situation. Well, I mean, nobody knows for sure, right? Can't guarantee anything, but that's it. And then if we look at fourth quarter coming up, I showed you that September drop in the fourth quarter. Let me bring this up a little bit bigger so you can see this. Historically, fourth quarter on the S&P 500, the average returns, quarterly returns since 1950 to 2020, up about 4%. So the anticipation of holiday sales and all that coming in and people buying things, we'll see what happens. We're starting to see cases drop in COVID as well around the country and the world. So hopefully that will be some positive news going into the new year and we get a bump on things. But if you're still concerned, like what's going on, what we typically do with our clients, just so you can see this, and actually, this is one other chart, real quick, I wanted to show you that this is interesting as well, is that when you look historically, if the S&P 500 is up at the end of August with greater than 15% gains, so this goes all the way back to 1954, the blue is what the gain was year to date at that time, and then the orange, red, whatever you want to call it, is the final last few months of the year, what it ended up doing. And it's very rare. We saw it in back here in 86, 87 with a drop those last months. But most of the time, as you can see, literally almost all the time, we've had some decent returns going into those last final months. And that kind of corresponds with that fourth quarter chart that I showed you as well. So the other thing to think about this too, and I mentioned this in my other podcast about pursuing stock market returns with less risk. Is that possible? Check out my other podcast on that. Is we really don't subscribe to market timing at all unless it's like a very small sliver of your portfolio, maybe 5% in that range, somewhere in there. Because if you look at this, is this the next big crisis? Who knows? You really need to make sure that the money you're investing in the stock category, the growth area, really has a 6-year plus horizon, in my opinion. I explained that in my other podcast, kind of the rationale behind that. because it is extremely hard to market time. I mean, I've been doing this business almost 30 years, and I don't know of hardly anybody that's been able to do it consistently, because the risk is this, and it shows it very clearly here. If you go back to 1990 to 2019, if you just kept your money in the market during that period of time, so basically a 30-year time horizon, you average 7.7%. If you just missed the best day of each year, you only average 3.9%. And that's why it's critical. If you miss these best big days, it can really hurt you long-term over a period of time. Missed the best 2 days, you only did 0.8. Missed the best 20 days of each year trying to time markets, you would have been a negative rate of return of 27%. That's just crazy. So we don't subscribe to that. What we do subscribe to is building out what we call a bucket strategy, where depending on where you are in your phase of financial planning, whether you're just starting out, coming out of college, got a new job, or just married with kids, stuff like that, making sure you have enough liquid money for emergencies. You hear the 3 to 6 month term. Sometimes people say, hey, let's go for 2 years of just liquid assets that you have access to in some capacity, in case there's a loss of job or something that can cover you through a big market downturn that can typically happen. And then if you're retired, maybe it's a longer period of time where we're keeping assets for 10 to 15 years and more conservative money that covers you for your first 10, 15 years of retirement. And then everything else, and what we call bucket 3 and bucket 4, is your growth money. That way you're not having to worry about these short-term end-of-the-world moments, if you will, that are always seem to pop up occasionally, once, usually about every 5 years. So that's kind of what we're talking about. Definitely feel like going forward in the fourth quarter still, there's some definitely momentum with the markets. Interest rates look like they're going to stay kind of stable here over the next 3 to 6 months based on what our guys are seeing on the 10-year Treasury. Our yields are still much higher than international yields, so a lot of people are still buying stuff there. And the Federal Reserve just talked about how they were thinking about looking at that curtailing of bond purchases and stuff, maybe interest rates increasing into next year. But we'll see. No guarantees as always, but greatly appreciate you joining on. And until our next video, let me show you real quick. If you have anybody that you know that would like to contact us, including yourself, to get a complimentary financial planning session, let us know. Take a snapshot of this. Check our comments section on the bottom. We'll have that information. Please subscribe if you're finding value, and share this if you're finding value that you think somebody else would find it of importance as well. Greatly appreciate it. Thank you very much, and have a great rest of your day.
Too many days in the darkness without a glimpse of the light. Running tired and broken and scared, but I swear I'll never give up the fight.